Hey, welcome back to The Dive. Today on the show, we have Peter Grandich of petergrandich.com. He's joining us today to share his thoughts on the collapse of Silicon Valley Bank and Signature Bank, what's happening with Credit Suisse, the February CPI print, oil, silver, gold, and be sure to stick around to the end to hear what Peter sees happening to our seniors. Hey, Peter, welcome back to The Dive. Thank you so much for joining us today.
Thank you for having me back as always.
Okay, so Peter, we have to get your thoughts on the bank collapses. Silicon Valley Bank said it was forced to sell part of its bond holdings at a loss of $1.8 billion, leading to a run on the bank. How closely are you following this story, and where do you think this is going?
Well, it'd be hard not to follow the story because it had such an impact on the markets. I say to myself, I wonder if it was the plumbers union and working class people that had over 250,000, would they have been bailed out the same way? I don't think so. The governor of California had $8 million there from his winery and stuff, and he was even petitioning the Fed to do something. So it was supposed to be non-insurable, yet they bailed him out. And what it made people think about is, well, if I happen to have more than 250,000 in a bank, are they going to bail me out too? And I'm a little peeved at that. And I'm also peeved off, to tell you the truth, that I found out that the bank itself has given $73 million to Black Lives Matters. I'm wondering if they gave any money to veterans groups or homeless people. This bank was a really woke bank. And there's people that believe in wokeness. I'm not one of them. And I think if they ever did a full investigation, they'll find that this bank wasn't really run properly. And then the stupidity of it, just to end on that note, they knew they were in trouble, and instead of publicly announcing they were going to raise money, they should have just went quietly to the Fed. But it is what it is. It really made people think again about our fragile financial system, and there's going to come a day when bailouts are just not going to work, and then that's going to be the domino effect to all the Armageddon predictions that have been around for decades. These guys will finally be right.
Okay, we also have to get your opinion on Credit Suisse. They recently announced that they are borrowing $54 billion from the Swiss National Bank. What are your thoughts on what's happening here, Peter?
This has been a bank that's been in trouble for a long, long time. Again, the European Central Bank probably would not want to see them fold up, but they've been trying to do a whole bunch of stuff that hasn't worked. And, we have this talk, you hear the saying, it's too big to fail. Well, I don't really think there is that case. I think you set a precedent now, and I think banks quietly or knowingly or a combination of both know that if they do something really wrong, they're going to get bailed out. I know if I end up going to the market right now, lose money, nobody's coming to bail me out. So, but Credit Suisse is a real trouble bank, and this doesn't mean that they're even saved. It may just buy them more time.
We've also seen Signature Bank collapse, but the media is not really talking about it much. Do you think that this might be the end for crypto?
Oh, it's not the end of crypto. I mean, crypto, for what it was touted 2 years ago, and I took a lot of flack calling it the tulip mania of the 21st century. We've seen so much loss there. There will be survivors. It's pretty much like the internet bubble in 2000. There's going to be a handful of survivors, and those survivors will end up prospering. But I don't think crypto is the answer to the cure-all for everything. But because Bitcoin is the most prominent one and known one, what's left of people interested in it are focusing there. And that's why it's probably going to be one of the likely survivors. But I certainly don't want to own it. And I think there's a much better hedge, and it's been around for a couple thousand years, called gold.
Okay, Peter, so the U.S. February CPI print came in at 6%. Where do you think we are in the inflation battle? And with the Fed's meeting around the quarter, do you think that we could see the end of rate hikes for now?
Well, two-part question. I'll answer the first one. I think inflation has always been higher than what government statistics say. Private economists that follow it come up with a much higher number. But whatever number you want to believe, the Fed is in a bit of a quandary here. Because of what's happened with the SV Bank, clearly a 50 basis point, which I think they were heading to do before this incident, because inflation hasn't come down the way they had hoped to yet. I think the 50 basis point is off the table. I think because the European Central Bank today went ahead and did a rise, I think that opens the door, as long as the market doesn't cave between now and their meeting, that we're going to get a 0.25, because they need to show that they stick to something. Remember, first they said there was no inflation. Then they said all the money creation won't create inflation. Then they said it's only transitory. And now, of course, everybody realized how far behind the curve they were. And they said they're going to stay sticking to their fight against inflation. So anybody who thinks there's going to be a cut anytime soon, I think is mistaken. There is still a chance they may do nothing, but I think that'll bring in more concerns of people saying that they're adrift, not knowing which way to go. I actually think for them, a 0.25 raise is the best move.
Okay, now let's talk about oil for a second. Its price has plunged by nearly 5%, the lowest in more than a year. What is your read on oil?
Well, it's way down from its high. It's not something I've been bullish on at all, but I can tell you some incidents that are happening that aren't getting the coverage I think are going to play a big role in oil. First of all, you're not going to see the oil companies spend money on new exploration. Not after the administration calls them every name in the book, treats them like they're the devil to the public, closes their pipeline, shuts off their abilities to explore, charge them with carbon tax up, and then asks them now to go out and spend billions of dollars to try to find more supply. They're just going to use what they have and distribute the money to shareholders. So that in itself is going to set us up for eventual another big run in oil. But something happened last Friday, and because of the SBB, didn't get much coverage. But China actually brokered a deal between Saudi and Iranians to talk again, to exchange ambassadors, what have you. And now China's leader is heading to the Middle East for a big summit. The Saudis have started to talk about moving away from the dollar and even consider entering the BRIC nation group. I just hope Joe Biden doesn't go over there again, because the last time he went, I think he did more damage than good. And that also is going to play a role, because I think the Saudis are not going to look to be highly favorable of keeping low oil prices. So it's probably going to stay down for a little bit more while because people are uncertain about the economy. But we're going to see oil again over $100 a barrel. I just can't tell you when.
Okay, now let's shift back to precious metals. Silver and gold had a good run recently. What do you think influences its price action?
Well, obviously the big run up recently was thanks to the news that central banks continue to be just the biggest buyers ever. And they're not buying for a trade or a speculation. They're buying at least to diversify away from the dollar. They may also be buying because they're concerned about geopolitical, but I think also that they're preparing for the inevitable introduction to at least regional trading groups that don't use the dollar, or a very large one like BRIC, and it may also use gold back. Plus, they've been underinvested in gold compared to where they used to be a long time ago. So I think that's been a main reason. Obviously, the concerns of monetary problems have supported gold, but gold remains really trapped in the trading range. And why more people are disappointed in it, even though it's really not doing bad at $1,900, is because most of those same people are also owning mining shares, and they're not doing well. And so they get more disappointed at gold than they should be. Gold should always be bought. I always tell people you should buy in and hope it doesn't make money. And you always get the same response. Why do I want to buy something that isn't going to make money? And I tell them, treat it as insurance, just like your car insurance and home insurance. Because if your gold goes up a lot, your financial assets went down a lot. And just hope that doesn't happen.
Okay, so let's look on the brighter side of things. What are the unexpected winners in the markets that you've seen so far this year?
I would say people like me that have been out of it. Not sure, because the volatility can make you have a few drinks each night. I would say that those who saw the opportunity of 1 or 2 year treasuries that briefly got over 5%, which I spoke about and I took advantage of. But I think the best thing that has happened for people that went into cash. It wasn't too long ago in late 2021, there was world famous hedge fund manager that said cash is trash. And I would say if you go from that point to now, most people would have rather had cash than whatever they did. So I think having cash is still useful. I still think there's downside to the equity market, and there's still some upside left in some speculative markets like copper and zinc and things like nature.
According to a recent survey from AAG, 89% of seniors are worried that the U.S. is in the grip of a retirement crisis and they're struggling to build their savings. What advice do you have for seniors with these kinds of conditions?
So I've been major hopping on this. It's part of my other business. I'm involved with a planning group here in New Jersey that specializes in retirement planning, estate planning, and teaching businesses how to exit profitably. I have told everybody that the retirement crisis is going to rival the debt crisis. We have 75% of all Americans now working paycheck to paycheck. In fact, recently they had to use their credit cards just to meet necessities because of the big inflation push. They have not had or will not likely have a chance to save enough money to retire or retire comfortably. Polls are now showing, and I happen to live in a senior group, in a senior complex, people are more concerned about running out of money than passing away. It's really a very frightful thought scenario for someone that's already stopped working or realizes they're going to have to work a lot longer than they expected. And of course, all those people are going to turn to the government to look for help in this. One of the areas where it's going to be impacted is senior housing and lower income housing, because people are just not going to be able to afford major typical type housing. But I also think there's one other problem, and I think this is the hardest one to accept, but I know it's coming. And that is there's going to be an age battle. The younger people are going to be more taxed because the only way the United States government can continue this unbelievable debt binge they've been on is they're going to have to raise taxes because they're not going to cut spending. They just don't know how to cut spending legitimately, politicians. So the younger you are, the more burden you're going to be taxed, and more likely you're not going to get the returns of the retirement plans of Social Security or the uses of Medicare. So they're going to put up a big stink and go, wait a minute, you're letting 85-year-olds get $300,000 lung transplants, whatever, and I have to pay higher taxes? No, I don't want to do that. And then the 85-year-old is going to say, wait a minute, you took out for me for all these years and I want to live and I want to have this. And that's already somewhat being seen north of the border. Canada instituted laws that have encouraged their medical societies, which are all socialistly run, to tell people of senior age that are either very sick or very concerned about living future that the alternative is to take their own life, which to me is just it's just another addition to the culture of death, which goes so much against my faith. But the retirement crisis is real. Wall Street has ignored it or makes like it doesn't want to know it or literally doesn't want to know it. And if you think about this, we'll close on this. Last year, the average retirement account in Fidelity was down 25%, and at least 10 or 20% of inflation for last year and this year. Those people lost a lot of money, and most of them are retired. If they don't have a market that not only gets back to where it was, but goes back to going up 20% or more, they're going to have a real difficulty continuing living their lifestyle. And that's the big issue. So my feeling is if this stock market doesn't recover, or worse yet, goes lower, those people are going to be forced to make decisions of coming out because they won't be able to handle the mental strain of being down so much. And that's where the people that are predicting a big market sell-off will be correct. I'm not one of them, but I think that's where they end up being correct.
Okay, Peter. Well, that's all we have for you today. Thank you so much for joining us. Before you leave, could you let our viewers know where they could go to hear more of your commentary?
Sure, petergrandich.com, but I spend a lot of time on Twitter. It's the best and easiest way to communicate, and my address there is @PeterGrandich.
Perfect. Thank you so much, Peter. We'll talk again soon.
Thank you. God bless.
To our audience at home, thank you so much for tuning in today. We will be back again tomorrow, so be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.